Hello and welcome to San Diego Market Watch for August 11th, 2022. I'm your host, Eric Edelman. So what's going on in the San Diego real estate market is pretty much the same thing that's been going on for several weeks now. Everybody knows that home inventory rose quite sharply, from the early part of May until the early part of July here. But the last several weeks, it has really leveled off. And I think we've seen enough weeks in a row now to call this a pretty solid trend. I really haven't seen anything that would indicate this number is going to run away from us. Of course, when it was going up and up and up and up and up and up, we were concerned that it was going to just keep going up. And with pending sales staying at a relatively constant level, and homes for sale rising sharply, that really could spell trouble for the real estate market in terms of supporting where the median price is and bringing that down very sharply, very quickly, which isn't necessarily healthy. But then the rapid rise in median price wasn't necessarily healthy either. So what we're seeing right now, at least since late June, early July, is a very stable level of homes for sale. And the other thing that we've been seeing in about the same time frame are dropping number of new listings. So new listings are just not coming on the market very, very quickly. You can go back here to June, early June, and see new listings at their lowest point in the last few months, and then they were definitely going up sharply every week. We had over 800, over 900, over 1,000, and now it's been coming down. And we see a little bit of an uptick here, but I don't I think this is more just a blip this week, unless we see a really sharp uptick in new listings with no corresponding uptick in pending sales. This is a very stable, very normal market at this point. Again, as I mentioned, pending sales throughout all of this have really stayed pretty stable. So the demand for homes really hasn't changed a whole bunch. Heading into the fall, things seem pretty good for buyers in that there are a fair amount of homes for sale, a couple of months worth, almost 2 months worth of inventory out there, so you have some choices. And things are still pretty good for sellers because prices are holding their own at this point, and there isn't a lot of really intense competition. There is competition where there didn't used to be, so you do have to be very cognizant of proper pricing. And frankly, I think that's part of the reason that we have some homes sitting on the market is just that people were looking at data from back here before May to achieve, determine their list price, and that is not what you need to be doing. You need to be really paying attention to what's happening with the data currently to arrive at a proper price and pay close attention to what the market feedback is telling you when you are on the market. So let's take a look at median price, which definitely has come down since March, April. We kind of peaked out right here, and it's come down. But look how far we came up from early this year. In January, we were down here under 800, and then at one point the median price got well over 850. I think it was 875 right in here for these 2 weeks, and then these 2 months, and then it's come down, but it is still much higher than it was earlier this year, and certainly going back to January of 2021, it is staggeringly higher. And that's the thing about these sharp increases in median price is they aren't really sustainable. We can't have median price growing at this level. Right here in May of 21, we stayed pretty stable through that summer and fall, and everybody thought, well, I think it's going to start to come down or soften up. and then wow, did we take off in 22. And so I'm not so worried about some softening in the median price number. I think it's healthy for the market, and there's probably some homeowners out there that don't feel that way. However, it is what it is. You just can't have prices growing at this incredible pace and sustain a healthy market. So what's driving a lot of this, or all of this, besides supply and demand, are interest rates. And last week we were down just below 5 at 4.99, or even earlier this week. And then the Freddie Mac numbers today show the national average at 5.22, which is quite a bit lower than it was just a few weeks ago. And I think while it's not ideal for home buyers, because they would prefer rates to be down in the 2s and the 3s where they were in January, but just like the rapid growth in median price, super low interest rates like that weren't sustainable either, because they were driving this rapid increase in median price. So in order to have a healthy, balanced market, things do need to be somewhere around this level. I think we're finding an equilibrium. It'd be nice if we could get rates down into the 4s again for folks. That would really help, I think, speed up home buying at this point. But demand seems to be relatively constant, and a lot of people are taking advantage of these 5/1 ARMs right now. And there's also a the buy down that you can do, the 2-2 buy down, or I forget what it's called, 2-1 buy down, where you pay a little bit of closing costs up front, or a couple of points up front, not a little bit, and you can get your rate down a couple of points for the first 2 years, and then it'll go up at that point, or you're kind of betting that the average rate will be down at that point, and you can refinance again in a couple of years. But the 2-1 buy down allows you to get a 30-year fixed loan, so you're not worried about this reset in 5 years. But these ARM loans are really very good right now. There's no real boogeyman out there that's going to come and get you when these things reset, because the lender is going to qualify you on the ultimate rate, or the rate in 5 years, or a rate that's 2 points higher. So you do have to qualify for the rate, versus the kind of ARMs that we had back in the 2008 realm, or before 2008, when everything went sideways. People were not being qualified for the real payment. So anyway, what all of this says to me is that the real estate market in San Diego is very steady and very stable right now heading into fall, and I really don't see any reason for alarm or concern, although the media is going to start reporting real soon that closed sales fell dramatically between June and July, and they did, but the reason for that was the fact that rates really spiked up and caused a real slowdown. And I think that we're recovering from that, the same way that fuel prices are coming down and recovering, and they're finding a floor that's higher than it was before, just like interest rates, but it's settling down from these sort of really uncomfortable highs into something that hopefully we can live with, and hopefully we'll see come down more in the future as we get a handle on inflation. So with that, I'm going to conclude today's San Diego Market Watch. Stay tuned to our YouTube channel for exciting changes on the horizon. We're going to keep bringing you great real estate information. However, we may start packaging some of it a little bit differently for folks. But as always, you can count on us for timely real estate information without bias, and very data-driven approach, versus any scare tactics that you might be experiencing out there in the regular media that doesn't take all of these things into account when they're telling you numbers. Generally, what the media does is they'll pick one dramatic statistic and try to get clicks with that versus really putting things in perspective, which is what we try to do here. So stay tuned for more. Tune in tomorrow for our Friday show, and we'll look forward to seeing you then.